Taxes are one of the most powerful forces shaping how people invest their money. Two investors may earn the same return, but after taxes, their final profit can look completely different. In many cases, the difference between a good investment and a great investment comes down to tax efficiency. Because what truly matters is not how much you earn, but how much you actually keep. Today, investors around the world are paying more attention to tax planning than ever before. Understanding taxes is no longer just an accounting task. It has become an important part of investment strategy. Tax efficiency simply means structuring your investments in a way that reduces the amount of tax you pay. The goal is simple: maximize after-tax returns, because every tax you pay reduces the total wealth you can build over time. For example, two investments might generate the same return, but if one is taxed heavily and the other has tax advantages, the second investment will create more long-term wealth. This is why smart investors always think in terms of after-tax returns, not just raw profits. Taxes directly reduce investment gains. Whenever you earn dividends, interest, or capital gains, part of that income may go to taxes. Over time, these deductions can significantly affect wealth accumulation, especially for long-term investors. Even a small difference in tax treatment can compound into a large difference over decades. That is why tax awareness has become an essential skill for investors. Ignoring taxes can quietly reduce the effectiveness of portfolio. One of the most common taxes investors face is capital gains tax. Capital gains occur when an investment is sold for a profit. In many countries, the tax rate depends on how long the asset was held. Short-term investments are often taxed at higher rates. Long-term investments may receive more favorable tax treatment. Because of this, many investors prefer holding investments for longer periods. It not only reduces trading costs, but can also reduce tax liability. Dividends are another important source of investment income, but they are also subject to taxation in many jurisdictions. When companies distribute profits to shareholders, investors may have to pay taxes on that income. This creates an important decision. Some investors prefer dividend-paying stocks. Others prefer growth stocks that reinvest profits instead of distributing them. The tax treatment of dividends can influence this choice. Many governments provide special investment accounts designed to encourage long-term saving. These accounts offer tax advantages. In some cases, investments grow tax-free. In others, taxes are deferred until withdrawal. Such accounts can significantly improve long-term investment performance, because more of the returns remain invested instead of being lost to taxes each year. This is why tax advantage accounts are often a key part of retirement planning. Another strategy used by experienced investors is tax loss harvesting. This involves selling investments that are currently at a loss. The loss can then be used to offset taxable gains from other investments. By doing this, investors reduce their overall tax liability, while the portfolio can still be repositioned into similar investments. This strategy requires careful planning, but can improve tax efficiency. Taxes also influence investment behavior in subtle ways. Frequent trading may generate higher short-term taxes. Long-term investing often benefits from lower tax rates. Because of this, many investors adopt a long-term approach. Holding quality investments for longer periods can improve both returns and tax efficiency. It also reduces emotional decision making in today's global financial world. Investors often invest across multiple countries. This introduces additional tax complexity. Different countries have different tax rules for dividends, capital gains, and interest income. Some countries have tax treaties that prevent double taxation. Understanding these rules is important for international investors. Proper planning can prevent unnecessary tax costs. Tax considerations often influence how portfolios are structured. Some assets are better suited for taxable accounts. Others are more efficient inside tax advantage accounts. For example, high-tax income investments may be placed inside tax-deferred accounts, while tax-efficient investments may be held in regular brokerage accounts. This concept is known as asset location strategy. It helps investors optimize after-tax returns. At the end of the day, investing is not only about generating returns, it is about keeping those returns. Taxes are an unavoidable part of financial life, but with proper planning, their impact can be minimized. Smart investors understand that tax efficiency is not about avoiding taxes completely. It is about managing them intelligently.